Markets can be very unpredictable things. When you're expecting a trend and it doesn't stay consistent, for instance, it can be incredibly frustrating for investors. Well, that's why in the studio I have Valerie Lemaigre, the Chief Economist and Head Researcher of Stigma and Partners. Valerie, thanks very much for coming into the studio. You said in your study, because you said you were doing you'd finished a study, you completed a study even, and it was focused on the Japanese yen. What are some of the things you've discovered?
We try to understand if the expectation of the market was something that could last, because in February, really market, because of the really high level of the yen against the US dollar, they were really trying to find out when the turning point could be reached. And in February, all of them were hoping about a reverting trend for three main reasons. The first one was the change in the monetary policy of the Bank of Japan. The second factor was the shrinking current account surplus, so the deteriorating external position of Japan. And the third factor was the strong economic, or let's say the economic momentum that was relatively good globally, including in Japan. So these three factors were really behind the hope of investors in terms of changing trend of the yen. But if we dig into those three factors, we could be relatively disappointed, and that's the reason why this trend is not really a strong trend. We have already seen some pullback of this evolution.
And that's something, because that's been the issue, hasn't it? The investors have been slightly frustrated because of a lack of consistency. So in your case, it's not been so much a discovery, as obviously I said earlier. It's more something that you've noticed from, you said, the monetary policy.
So first, the monetary policy. So what the Bank of Japan announced in February was, first of all, an increase of their asset purchasing program by 10 trillion.
This is the Bank of Japan?
The Bank of Japan. And they adopt this liquidity in April by raising again this program by 5 trillion and 10 for purchasing GGB, which are the Japanese government bonds. And the second factor of the monetary change was the introduction of an official inflation target of 1%. So behind all of that, people were expecting that liquidity injected in the system would really weaken the currency and promote some inflationary pressure. The problem with the size of this monetary policy is that it's still not ambitious.
Okay. What about the positivity globally? Because we were talking before the interview about the economic situation globally, and that, for instance, Japanese investors will sort of invest properly if globally everything is positive, if you like.
Yeah, and maybe to really explain deeply this factor, which is linked to the portfolio flows in Japan, is that whenever they are really positive regarding the global environment, they invest outside. So they promote outflows, and that is a factor of weakness. And why do they need this in Japan to weaken the currency? Because traditionally the current account position, which include the trade balance, which include income balance and services balance, is positive and is increasing. So traditionally you have a natural appreciation of the yen currency, which is like we can compare with the Swiss franc. If you have a country with an external surplus, you have a natural appreciation of the currency. So the second factor I mentioned before is important to understand the impact of the global growth, is that recently we had bad figures in terms of external trade deficit in Japan. And people were saying, well, this is the start of a trend. Japanese deterioration of the current account surplus is a new factor that will continue because it's based on structural factors. And that's where we found that is not the case. For the moment, is really the deterioration of the current account was really due to cyclical factors like, the earthquakes, the Fukushima nuclear crisis that imposed a lot of imports of energy. It was also due to a slowdown in the trade with China. So it's much more cyclical factors that are affecting the current account surplus than structural one. And then the final factor is linked to that, is that if you have a natural position of the yen which has to appreciate, you need to have really portfolio outflows to be sure that you can trigger a significant depreciation of the yen. And that is not the case for the moment in Japan. That could be the case because of the good economic momentum in February, but this global economic momentum has already faded. We have seen it in the US, we are seeing it in Europe. So that's the reason why Japanese are not confident to really invest outside, and that's also the reason why you don't have all the factors really pushing the yen to a lower level.
Thanks very much for coming in the studio, Valerie. Now, that's very detailed insight there. Thank you for that, though. That's all we've got time for on Dukascopy TV at the moment. Obviously, stay with us throughout the day for further updates and exclusive interviews. Until next time, though, goodbye.